Good evening and welcome to the Money Show, the show that puts your money matters front and center. In a world full of financial noise, we are here to bring you clarity, confidence and control over your personal finances. Whether you are planning for retirement, building a portfolio, navigating debt or just trying to make smarter money decisions. Now, this is your space, your guide and your weekly check-in with your wallet. Now, every evening we bring you insights from top financial experts, decode the latest trends and answer your burning questions on saving, investing and spending and everything in between. Because here on the Money Show, we believe one thing: you don't have to be a finance expert to take charge of your money. You just need the right advice. So let's begin. And so when it comes to the stock markets, as well as US President Trump, nothing can be said with 100% certainty. We can only talk about things in terms of probability. So there is now a high probability that an India-US trade deal will be signed sooner than later. Now, when it comes to the second part, the fact is that the real impact has been limited only to some sectors. Topping the list are textiles, shrimp and fisheries exports, auto ancillaries products and select chemicals. So when these tariffs are reversed, these are the sectors where stocks are likely to see a bounce back. When one looks at the Q2 numbers of several apparel makers or those supplying bed linen and other home products, there is something decidedly odd. Their sales numbers are better than expected for the period in which tariffs were implemented, because we increase our exports to the other markets. Talking about our domestic front, our key macro data showing easing inflation and strong industrial momentum. Inflation continues to stay subdued. From a market perspective, equities rebounded strongly in October. The Nifty 50 rose approximately 4.5%. Sensex by 4.6% over the month, driven by a mix of domestic flows and improving global risk appetite. Now, we've also seen a lot of sector participation, which is the metal index going up. IT and pharma were the laggards. November somehow saw a low and also seeing high with almost good Q2 results. Shutdown ending in the US. However, while the macro backdrop is improving, valuations are elevated in pockets and global uncertainties, including China demand, US interest rate trajectory and the energy complex remains live risk. So what should you do as an investor? Investors may need to shift from broad momentum to selective structural advantaged themes: industrial strength, capital goods, infrastructure, domestic consumption and export play, companies that are less vulnerable to external shocks. But, on this show today, we'll explore how retail investors should interpret this environment and what to hold, what to avoid, and how to navigate potential volatility. We are now joined by Shubhani Kurran of Kotak Mutual Fund. Shubhani, hi, evening and welcome to the Money Show. And first question to you. What kind of a November so far it is as compared to October?
Hi, Kavita. Always a pleasure to be on your show. So, of course, there has been a lot of changes that have taken place, especially where policy is concerned domestically, with momentum coming through, given the kind of fiscal push that we have seen with the GST rationalization. So, November clearly was a month where the focus was on the corporate earnings season. Corporate earnings season panned out to be slightly better than expectation, though the expectation itself was muted. However, when you look at the broader market seems to suggest, one, the earnings downgrade cycle is possibly coming close to an end. If you look at, again, broader market, especially mid-caps, earnings were fairly strong. And management commentary as far as demand post the GST cut implementation seems to suggest that there is improvement, and a substantial improvement, especially in pockets of discretionary consumption. So net, our view is that from here on, given both the fiscal policy as well as monetary policy push, demand should start to improve, and some of that should possibly reflect in terms of better earnings growth in the second half of FY26. And in that context, we expect H2 should be better than H1 in terms of corporate earnings for FY26, and FY27 should also see better momentum on earnings growth, which is key for our markets.
Absolutely. So, let's just elaborate more on the Q2 results also. So far, what's the sense are you getting? Strong set of numbers, even expectedly, surprisingly good numbers. Can we say that?
So I think when we went into Q2 of FY26, expectations itself were muted. Remember, the most of the impact
Right.
of the GST benefit flows through post September 22nd. So a lot of that will possibly reflect in Q3. And as a
Mm.
result of which, the delivery of numbers for Q2 were largely in line with expectation. But as I mentioned, the most important takeaway was that there were no major earnings downgrades for the year. So if you look at sectors that contributed to Q2 earnings, segments which were slightly cyclical like metals, oil and gas, some parts of financials also saw better delivery of earnings, autos, telecom, and healthcare. Now, one big takeaway for us from a sector perspective in the Q2 earnings was that financials, which were expected to see significant amount of margin pressure, actually did not see the margin pressure. So that means net interest margins kind of stabilized. And if you look at the recent data on loan growth, there seems to be some acceleration, and management commentary seems to suggest the same. Another
Right.
big takeaway was that from a mid cap space, earnings held up. Those small caps, if you look at a segment as a whole, earnings were muted. So, net for FY26, we expect earnings to be in the high single digit to low double digit, and then acceleration in FY27, where consensus today is building in mid teens earnings growth for Nifty 50 companies.
But then what about valuation concerns in the mid-cap and smaller space? You know, the broader markets, do you think have corrected so far where we could see realistic valuations?
So valuations, clearly risk reward still is in favor of large caps. So today when you look at Nifty
Sure.
50 valuations on FY27, we are about 20 times, which is in line with long-term average multiples. Therefore, valuations look reasonable there. For mid caps, valuations are slightly elevated as compared to their historic average multiples. However, as I mentioned, the growth in terms of earnings for mid caps has been strong, and therefore one can look at bottom up opportunities and stock specific plays as far as mid caps are concerned. Small caps is one segment where we remain cautious. Here, earnings delivery has been muted and multiples are still elevated as compared to their long term average history. So, net market valuations have corrected, especially for large caps where they are in line with long term history. More importantly, if you look at India's premium to emerging markets, India typically trades at a premium to emerging market countries. That premium had become elevated some time back, but now with the underperformance of India, that premium is back to again long term average history, though India continues to trade at a premium. So, in parts, the risk reward still is in favor of large caps over mid and small, but bottom up opportunities present as far as mid caps go.
All right. Let's also talk about a sector play going forward, you know, specifically focusing on Q2 and Q3. Now, sectoral funds, we've seen industrials, metals showing strength, IT, pharma slightly underperforming. The consumer theme is really playing out right now. But do you think the structural shift is that we are witnessing right now is here to stay longer?
So I think the way we look at sectors and performance in terms of demand across sectors, clearly domestic facing sectors are faring better than export oriented sectors at this point in time, given the global uncertainty that you're seeing on trade and tariff. Secondly, policy continues to support domestic consumption and domestic demand. So if you look at in total, starting with the income tax cuts, GST rationalization, as well as the transfer to the women by various states, the total kind of policy push has been about 1.6% of GDP, which is a substantial number. So, from a sector perspective, even what we've seen on commentary as well as Q2 earnings, discretionary consumption continues to be one space where we are positive on. Banking financial services at the margin seems to be showing signs of improvement, and here valuations are in your favor. And the third segment that we are positive on is the healthcare space, specifically hospitals. Here, valuations are not cheap, they are somewhat elevated, but we think that the structural opportunity for the sector remains intact.
All right. Now let's also talk about the SIP numbers and the kind of cautious approach that we saw in the latest Amphi data. You know, a lot of money going into flexi caps. That's again a winner. I think consecutively we are seeing every month flexi cap category doing well. Mid and small cap we are seeing low numbers since last 2 months now. As I'm listening to your commentary also, you're largely large cap focused. You think investors are really sensing this now, and so they have increased the participation towards flexi cap, towards hybrids, and they really want to go diversified. Is this the kind of message that we are getting from retail investors doing SIPs?
Yeah, so our way we've looked at investment and what we've been telling our investors, one, SIPs continue to be the best way to invest as far as equity markets are concerned. If one is looking at lump sum allocation, a multi-asset allocation fund or a hybrid fund, which leaves the asset allocation to the fund manager, makes the most sense, because then the asset allocation part is taken care by the fund manager. And finally, in terms of overall allocation, clearly our view has been that tilt of portfolio should be more large cap, neutral to mid, slight underweight on mid cap. And of course, when you're looking at investing in mid and small caps as categories, one needs to have a significantly long term horizon, because obviously this is something that plays out in terms of growth over a long period of time. So yes, the way we would be advising is that portfolio tilt should continue to be large cap oriented. Build your portfolio in a staggered manner. SIPs continue to be the best way to invest as far as equities go.
All right, one last question, and then we'll wrap this particular discussion. Now, since we've focused about Q2 and Q3, I really want an overview of this entire calendar year. Okay, Shubhani, because it's almost the end of the year now. Definitely, we'll be talking to you later on also. But then, just getting just talking about an average of how this kind of a year was from markets perspective, from sector perspective. We definitely did not start the year or continued the year the way we were expecting. How has it turned out so far?
So this has been a year of consolidation for our markets. The period between 2020 and 2024 was a significantly positive period for equity markets in India, and rightfully so. And therefore, after a period of a long up move, we saw markets consolidate in 2025. So if you look at the year, one, it's been a year of consolidation. Two, it's been a year of bottom-up stock picking, where focusing on individual stocks, to identify stocks where earnings trajectory is higher than market, and companies that are gaining market share and trading at reasonable valuations has helped in terms of portfolio construct. So I think if you look at the year, there have been three key factors that have shaped the year. One has been the uncertainty on trade and tariff, and that uncertainty still remains, and we are hopeful that maybe we see some solution going forward. Second, corporate earnings have been muted, and as we were discussing earlier in the show, second half of the year should possibly now start seeing an improving trajectory. So that's something to watch out for. And the third part has been flows. Flows have been volatile, especially where FII flows have been concerned, though last 2 months have seen some stability there. And domestic institutional investors continue to be net buyers. So I think the market this year has been year where again navigating through ups and downs has been part and parcel, and hopefully from here on, given that valuations are a little bit more reasonable, and if earnings trajectory pans out as we expect, we should possibly see some amount of good news as far as markets are concerned.
All right, so good news. Second of the year is going to be good, and so far, all you have to do is just be equity neutral, keeping your bias or heaviness on the large caps. Thank you so much, Ivani, for taking time out and helping our viewers strategize their investment portfolio towards equity today. Thank you so much. And on that note, it's time for a short break on The Money Show, and post that, we'll be joined by Vishwajit Parashar, who will be answering your portfolio queries in a bit.